Off. What's up, Mortgage Coach community? Dave Savage and Joe Patour, president of Mortgage Coach, coming live, interviewing special guest Mitch Kider. Mitch, it hasn't been a long time since I talked to you because I saw you in Nashville, but it's been a while since we've had you on the Mortgage Coach YouTube channel.
It's been a little while. I thought you forgot about me, man. It was great seeing you in Nashville, though.
It was great seeing you, and you're such a gift to the industry. I mean, not only are you an awesome compliance attorney, but you're just an awesome human being and leader in the mortgage space. So thank you for everything.
You're a good man for saying that. I thank you for that.
Yeah, well, it's very, very true. So first of all, any loan officer listening to it, this is the guy that your CEO, your head of production, your C-suite goes to keep you out of trouble. So he does a lot of mock audits. So trying to keep you guys smart and doing the right things. And then he's also the guy that when there are complaints that they go to. So he's not a guy that you usually get to hear from firsthand. You know, it's a real honor. I don't even know what his price tag is, but it's, call it one of the highest paid, if not the highest paid legal counsel in America for the mortgage industry. But more importantly, he is reshaping a lot of the laws. I mean, he's, when there's class action laws, Mitch is out there. Mitch, anything you want to say about your role in the industry before Joe and I start drilling you with questions?
Listen, for those of you that are listening, you work for a fantastic industry. I've said this many times over, and you house America. We have the best housing finance system in the world, bar none. And you guys are absolutely essential, integral to that particular system. I have actually represented this industry for almost 41 years now, trying to keep people out of trouble, trying to make sure it's moving forward, and trying to make sure you guys are doing the right thing. So it is a pleasure to be here, and it's really a pleasure. It's an honor to be able to talk to the Mortgage Coach community. So thank you, guys.
Yeah, and guys, I don't know if it would be the Mitch Kider story, but there's a 5-minute video that the NBA put together that tells your story. What would be if we wanted to find that on YouTube, what do you think would be the Google search?
So it's on Vimeo, actually. It's called Mitch Kider, The Power of Homeownership. That's where you would.
So Google that and we'll find it. I'll put a link down below. I highly recommend you check it out. It's super inspirational. This man has dedicated his life to the mortgage industry. And when you hear his story, about why and how committed he is to it, it's pretty inspirational. So Joe, before we drill him, anything you want to say to open up the call?
No, I would just remind everybody that, compliance can be a competitive advantage. And when you look at how you put the borrower first and how you put process and procedure to help you do the most volume in the most efficient way while reaching the most borrowers possible, you can have a fantastic lending operation that succeeds in any changes in market conditions. And so taking the insight from an expert like Mitch and putting compliance to work for you really can be an advantage that I hope everyone here takes advantage of. So Mitch, thank you so much for taking the time for our community.
Hey, it's my pleasure.
Cool. So Joe, let's you and I take turns on asking questions. I'm going to open it up because I know I wanted to call you personally on this, but when I saw the news that Redfin had acquired Bay Equity, I kind of knew this was happening, but to me it was like a new pivot where typically the mortgage loan officers that work within real estate companies or owned by real estate companies, they're not necessarily the best loan officers. And when I saw them, hey, let's acquire a company that's got a lot of great local referral-based total pros, mortgage coaches, Bay Equity is a mortgage coach client. I thought, flight to quality. You're going to see a better quality, a mortgage professional. If you could, one, speak to that. And then 2, tell us if you think we're going to see more of this trend. And then also if there's any compliance things that loan officers should know about, we'd love to hear you unpack that.
So let me just tell you, I actually think that the deal between Redfin and Bay Equity is a brilliant deal. When I kind of knew what was coming down as well. And I think that when it came down, it's 2 great companies. I know Redfin well, I know Bay Equity well. Two excellent operations coming together makes all the sense in the world. I really like that. I think you're going to see more deals like this coming down as well. Yeah, I mean, you talk about your typical loan officer in a captive company, they know that particular business. And they're simply, for the most part, they're serving their parent company. And that's fine. There's something to be said about that. But Bay Equity is a great mortgage operation. It's really no one's captive, quite frankly. It's got great resources on its own. It's got wonderful loan officers. And this type of a deal makes all the sense in the world. It's not one of these cases in which, mortgage business is solely generated by your parent company, or in this case, mortgage business is not going to be solely generated by Redfin. There's a lot of synergy over here. Bay Equities brings a lot to the table, and they're going to bring a lot of business to the table as well. And the synergies that are going to work between Bay Equity and Redfin is actually, what they contemplated back in the 1980s when they passed the affiliated business amendments. They said ultimately, affiliations between providers are good for the consumer. They make a lot of sense, and the synergy works from a cost perspective, from a knowledge perspective. You're going to see a lot more of this going on, and consumers today, regulators not so much, but consumers are really looking for a one-stop shop as well. And I think that this goes a long way to helping out to get there. So I think it's a brilliant deal, as I said.
So I'm going to give a few thoughts, and then Joe, hand it to you to unpack that with Mitch a bit and ask the next question. I do want to thank Pablo, who's watching this live, for posting a link to Mitch's video. So thank you, Pablo. And guys, check it out. If you're watching this in YouTube, we'll have a link below this where it's a description. We'll have a link to that. Watch it. Know who this man is. So tell me what your thoughts on this, Mitch. My takeaway is that loan officers need to be more integrated into the real estate agents' sales experience than ever. And it really elevates the importance and value of a mortgage coach, because they're able to ask a family, what are your hopes, dreams, and goals, and then give mortgage options in a digital, modern way with a video. And it should be a wake-up call for every loan officer that if you want to keep getting business from realtors, the best thing you can do is deliver incredible advice that's consistent, that's compliant, that's digital, and the bar's higher. Like being, just relying on a relationship when they're buying companies like this, their in-house person is going to be better than ever. And that means you need to level up. Do you agree with that?
Oh, I completely agree with that. And I think you're seeing that happen in the industry otherwise as well. Loan officers are stepping out. They're an integral part of the actual real estate transaction itself. And they have to be that way. Years ago, it was very, very different. You solely dealt with your broker. When you were done along those particular lines, you moved over to your lender, and it worked, it didn't work, or you didn't necessarily walk into the right product or have a good understanding as a consumer as to what it is you were fully getting yourself into. It's got to be integrated more. And I think a really good, strong loan officer that has the best interest of the consumer at heart plays a big, big role in that integration of the overall transaction. This thing about, having the different pieces of a real estate transaction or a residential acquisition put in separate silos, I don't think has ever been healthy, in all honesty, for the consumer. I don't think it was ever really totally in the consumer's best interest to do that. And so, yes, loan officers, the bar has been risen here. It's a higher bar, quite frankly, but it's a hell of an opportunity for loan officers to play a role in the overall transaction, the bigger picture itself, and show the importance to the consumer of getting that financing right.
So Mitch, when you think of that opportunity and you think of relationships like what's demonstrated with Redfin and Bay Equity and the synergies in between, when you're a lender who's listening to this conversation and they're thinking about the cautions behind MSAs or other types of relationships with folks that are in the real estate transaction, what sort of guidance, when you think of that direction where we're headed, where the customer is expecting a more cohesive relationship between the agents and the funding and the financing. How can folks here can get started, and what's going to happen with MSA-like agreements moving forward?
Well, listen, there are a lot of different type of agreements out there. An MSA is really a marketing service agreement. I'd put that, separate and apart, and that's really when the lender or the loan officer is, going to a real estate agent or a real estate broker, or, and saying, advertise me, and I'll pay for that advertising. It's kind of important to some real estate companies because, they don't get the same commission that they used to get. Some of them don't get any commission anymore, so they rely on those ancillary fees for MSAs. But let's set MSAs aside and, talk about other things like joint ventures, right? Where you come together, two companies come together and form another one that puts the real estate operation, effectively in the mortgage business as well. Those, there's a proliferation of those going on right now. So I think that, real estate brokerage companies and real estate agents recognize the need to be more in this particular business. And on the mortgage side, they certainly recognize the need to effectively open those doors up to these other real estate companies. The bottom line with the, in terms of advice, in terms of, compliance, is most of this is going to come down to a simple RESPA analysis. Now, a lot of people think RESPA is really complex. I've litigated cases against the government under RESPA that's, that the government would tell you, wow, this is really complex. I litigated a case that resulted in about 110-page decision that says, from a court that says, here's how you interpret RESPA. The bottom line here is no one should give and no one shall accept a thing of value for the referral or settlement service business. That doesn't mean you can't work with a realtor, okay? That does not in any way, shape, or form mean that you can't work with a real estate, agent. It doesn't mean that you can't add your expertise to the particular process. What it means is you can't pay for a referral. It's an anti-referral fee statute. That's what it is. No kickbacks, okay, because someone's sending you your business. You don't have to pay a kickback if you show your value in the business itself, if you work together. And so it's proper structuring, in order to be compliant, to make sure it's not simply a matter of, hey, send me your business and I'll send you something, okay? That's not cool. That's not good along those particular lines, only because you have a statute that says it's not a referral for a referral. You can't do something along those particular lines. But that doesn't mean that you don't bring something valuable to the table that ultimately benefits the consumer, okay? That you can do, and show your value to the real estate agents and to others that you're doing business with. And believe me, they don't need your cash as a result of that. They need to know that their loan is going to close. That's what they need. They need to know that that transaction is going to be consummated.
So for folks here who want to take the first step in setting up a joint venture, or they have agents where they think this makes sense to roll together, or take that step to duplicate at scale what's demonstrated with Redfin and Bay Equity, what would a lender's first step be from your view?
Well, so first of all, what's happened with Redfin and Bay Equity, that's a nice deal. That's a large deal. A lot of the joint ventures you see today are much smaller in nature, and they are with a mortgage company and a real estate brokerage operation, for example, something smaller than a Redfin, although it can happen on a large deal as well. The first step is really knowing and understanding that you're creating a real business. Okay, that you're not just setting up a business so that your partner will continue to refer loans into it and be able to get paid, and that's the only purpose for it, but you're going to take care of everything yourself. If you're going to set up a joint venture, the joint venture company has to be a real company. You're going to set up a joint venture mortgage banker operation, it's got to have its own employees. If it's a mortgage banker, it's got to have its own loan officers. It needs some processors. It's going to need an underwriter, or several underwriters, depending on the size of it. It has to look and feel and act like an independent company would otherwise act. That's what has to happen with that. If you look at Redfin and you look at Bay Equity, believe me, Bay Equity looks, feels, and acts like an independent company would and does. And they've done that for a long time, and it's going to continue on along those lines, once everything is consolidated. So that's the first thing you have to understand. It's not just a mechanism, or it's not at all a mechanism to say, wow, I have this thing called a joint venture. Let me set it up so I can put money into my realtor partner's pocket and I don't have to worry about anything. You can't just do that, because ultimately it's going to be a sham. You got to set up an operation that actually purports to do what you say it does. That's really important. And stemming from that, once you have that basic understanding, you have to understand, as is true with any other business, it's got to be capitalized. Okay. The only thing your partner can get is a return on their ownership interest out of that joint venture. The only thing you can get out of that joint venture is a return on your ownership interest. How do you determine the ownership interest? Look at the overall capital. What percent did you put in? What percent did they put in? That's really important, because otherwise you're in violation of RESPA if you compensate in any other way on a joint venture basis. So you need to understand that part of it as well. And then you need to understand, basics about corporate governance. Your joint venture has to manage its own day-to-day affairs. As I said, it's got to be a real company that looks and feels like a real company. But it can be done. It can be done. There are many out there. There are many successful ones out there as well. But understand those key concepts and you're on your way.
So Mitch, before I ask this next question, I was able to actually download that video from Venmo. Are you cool if I put it into the Mortgage Coach YouTube channel just to get some extra distribution on that?
Sure. I have no problem with that at all.
So guys,
I think you froze.
Looks like, Dave, you're frozen. You can jump back in with that, but to the viewers, I'm certain that we're going to share that video in the YouTube community. But again, kind of looking at the overall conversation. So you set up a successful joint venture. Now you talk about just where the industry is going. We're shifting to a purchase market. You certainly have some pressures on the lender to make sure that they're being purchase focused. And then you think about, communities that aren't getting the type of access to home ownership that they should, the folks that are in communities that are underrepresented. So when you think about joint ventures and you think about the types of charters that lenders have to increase home affordability and the opportunity that serves, or the risks that are there when approaching certain specific markets, what would you have to say on that topic?
Well, I mean, the bottom line is when you put these two things together, it actually works well. It's not a bad idea at all to create a joint venture that focuses in specific areas. Fair lending is so important, not just to your industry, quite frankly, to this country. Fair and equitable lending and fair housing is a civil right. And pursuing fair lending, as I said when I was in Nashville at the IMB conference last week, is a cornerstone of the Biden administration's civil rights policies themselves. So, in order to, you need to open up markets. I mean, the reality is, statistically, it can be shown that majority minority census tracts, high minority census tracts, LMI areas have not gotten necessarily a fair shake. And when it comes to housing finance. That's statistically, that's just the reality of what we have here. Can you use something like a joint venture to open up new market areas, to create an entity that, that's going to focus on specific, high minority market areas and things of that sort? Absolutely. Absolutely. It's a good tool. And, there are plenty of other settlement service providers, real estate brokerage companies, real estate agents. There are plenty of people in these minority communities that actually would render themselves to be good partners in putting together a venture. More financing is absolutely needed.
Well, it's exciting and encouraging to hear you connect those dots, and hopefully that is inspiring for folks in the audience here. When you think about the importance of using technology and other innovation to open up home ownership access and to ensure that lenders here are meeting expectations and the rules that they need to follow, certainly we echo well and support our compliance departments and the lenders that we serve. But what's most important from a lender's perspective of what they need to institute and ensure is in place to avoid disparate treatment issues and expose lending to more communities today?
Well, they have to work at it. They have to work at it. And you start off by understanding what your lending patterns are. So the first thing that you're going to do is do a data analysis. You're going to have to see now your HMDA data, ever since 2018, when there were many more data points that were filed, your HMDA data makes what you do as a loan officer and what your company does an open book, quite frankly. You can see exactly where your lending is, what those patterns are, what your pricing ultimately looks like, and that's really important. But companies need to analyze that data to see how they're performing, especially how they're performing vis-a-vis their peers. And your peer is really anyone else that's lending in one of these minority census tracts. That's your peer. There used to be other definitions that we used, 50% of your loan production was a company up to 200%. Not anymore. The CFPB kind of maintains a position. If someone's lending over there, that's your peer. And we're going to look at your proportionate amount of lending compared to their proportionate amount of lending. So you have the material, you have the data available to you to know and understand whether or not you're doing your job and whether or not you're excluding specific areas or you're pricing poorly in specific areas, or whether in fact you look good and you're pricing equivalently to the manner in which you're pricing in majority areas, and whether or not you're taking applications at the same rate as your peers do, proportionate to the overall amount of business that you have. Absolutely critical. So it starts with a data analysis. So you know and understand that, and from that data analysis, you're going to look and find out where you stand. And then it comes down to, okay, so what am I doing right now that's either leading me not to capture enough business, not to capture enough applications? And that's going to come down to outreach. Okay, what kind of marketing are you doing? What kind of community service are you doing? Are you dealing with community organizations? Are you dealing with minority brokerages? You have to look at your own company as well. How diverse is my MLO population? Because the reality is, just in stark terms, if all of your loan originators, are, white men under the age of 62, you're going to have a hard time getting loans in specific areas. Okay, people like to do business with people that are like them. That is the reality of the situation. So you have to look at all of those things and put it together and move in the right direction to make sure that you're in a position to capture business, to make sure you're in a position to get those applications.
So Mitch, when we were together in Nashville, I remember writing it down, and I think a comment you said multiple times: this is going to be the year of fair lending. There's going to be an increased amount of compliance. And as Joe said, when we opened this up, compliance can be a competitive advantage. And, here at Mortgage Coach, every social media post I do this year, guys, it will be #mortgage coach, #essential. I want the referral-based local mortgage professional to be essential to the family they serve. And part of that is delivering that total cost analysis and being consistent with the delivery of that, and so I'd like, I know Joe talked about disparate impact, fair lending, but I'd like you to speak to the concept of, giving every family a consistent experience like a fee worksheet, and maybe speak to the fact that if, one family gets a mortgage coach, options, transparency over time, and another person gets, an email, another person gets a fee worksheet. Could you speak to that in the context of fair lending and disparate impact?
Yeah, so absolutely. So, most of the fair lending investigations today, and most of the fair lending matters that are being pursued, are being pursued under the Equal Credit Opportunity Act, ECOA. And that's not typical. That's different than in the past. Because what ECOA says is you cannot discriminate against an applicant. But the regulation to ECOA goes a little bit further than that and says you can't discourage someone from applying for a loan. You can't discourage an applicant from utilizing your particular company. You want to translate it to what Mortgage Coach is doing and what you're asking the Mortgage Coach family to provide in terms of consistency. There's a direct correlation there. Okay, you have to be consistent with everyone. You're going to do a total cost analysis. You have to be consistent along those particular lines. Because if one family is getting a total cost analysis, if another family is simply getting an email, if another family may not be getting anything, they have to walk into someone's office and kind of pry the information out of them. The family that's simply getting the email, the family that has to walk into an office and pry any information out, basically beg to be an applicant, okay? That is a form of discouragement. That's a company or a loan officer that's effectively saying, I don't really want to do business with you. So that you're discouraging that individual from doing business with you. And that is a violation of ECOA. And today, the CFPB and the Justice Department maintain that when you discourage applicants in certain areas from applying for a loan, you are effectively redlining that area. And that's what you're seeing in cases that are out there. So, I'm glad you brought it together that way, Dave, because, it fits hand in glove. Consistency, consistency, consistency. Everyone needs to be treated the same way.
And here's the deal, guys. I've interviewed hundreds of America's most successful loan officers, and the difference between most of them is consistency. The best of the best don't treat the rate shopper one way, the person that barely qualifies that a different way. They get good at something because they're consistent. They ask similar questions. Of course, they tailor it. You might ask different questions of a first-time home buyer than someone that's on their fifth house. There's a difference when you're educating someone for the first time. But when it comes to serving families, and that's another thing, I love our new partnership with Sales Boomerang, and so happy that LR has both of us, because the theme of Sales Boomerang is leave no borrower behind. That means every single borrower needs to get advice. And I'd love, this is not exactly a compliance question, but I'd love your thoughts of this as a mortgage leader. Is I think that there is a financial literacy crisis in America. People, whether they're graduate from high school, college, or they're adults, they don't understand money. They don't understand the finances and the numbers of renting versus owning. And I do think the mortgage industry is in a really unique position, because the mortgage is the biggest liability that a family will ever have, and the biggest financial planning decision that 95% of Americans will ever make. I think we're in this really unique position as an industry. If we do the right thing and we give people a little education and we give them a total cost analysis, we're going to have better conversion rates. We're going to be more compliant, and we're going to be more profitable. What are your thoughts on that as just an industry leader?
So there has been a financial literacy crisis in this country since the beginning of days, quite frankly. They don't teach it. You don't get it in high school. You don't get it lower than high school. They, for the most part, they don't teach it in college unless you go out there and you seek that information. Education is absolutely critical, but it's missing. It's missing. Not, both generally in terms of financial literacy, generally in understanding money, understanding how to deal with money, understanding how to save, understanding the meaning ultimately that, the impact that it's going to have on you. But even more specifically with housing finance itself, I would venture a guess that the majority of people that graduate high school do not know how to purchase a home, do not understand that they can get a mortgage, do not understand financing, certainly don't understand the terms of financing or the different loan products that are available to make it more affordable for them, given their unique financial circumstances. And I actually hold by that. I believe the vast majority of people that graduate high school have no idea, And I believe as it goes on, there are many people that never really pick that up. So, if you can educate, if we can educate, society along those particular lines, not only is it beneficial to the consumer, and it's tremendously beneficial to the consumer, but it's going to be so much more beneficial to your business as well. Because, there used to be a clothing store years ago. I think it was called Sims. I don't know if you remember that or not, but they had a lot of designer clothes in there at a wholesale rate and things of that sort. I remember when I first graduated law school, I needed to buy some suits and I needed to buy it on my very limited budget. So I went to Sims. Well, their advertising motto was always, an educated consumer is our best client. And that's absolutely the truth. And that's true for you guys, and it's true for this particular industry as well. An educated consumer is your best client. And if you can bring them that education, believe me, they will bring you a lot more.
So, challenge to the mortgage coach community, and I've done a few interviews on this, where the best mortgage coaches, they're giving every family a total cost analysis at the point of sale, but they're also teaming up with realtors, CPAs, and financial planners, and they're volunteering at local high school and colleges. And the beautiful thing about that mortgage coach community is, one, you're giving back and you're helping solve the fiscal literacy crisis in America. And two, they're getting loans. They're getting loans from teachers, they're getting loans from parents, and they're educating the next generation. So I'm going to focus on that a lot throughout the year. I'm going to shine a light on mortgage professionals that are winning through education. They're consistently giving their families a total cost analysis. And then, to me, we're raising the bar this year, guys. That's great that you've done 1,000 TCAs and that you're doing $100 million a year in business and you're killing it. But it'll be great when you're doing that and you're volunteering at high schools, colleges, boys clubs, girls clubs, anything and everything you can do to do this. And you know what? You'll get paid for it. You'll get paid, right here, and you'll get paid in the pocketbook. Mitch, anything else you want to say about that topic? I know Joe is passionate because we're working on our reverse mortgage solution, and I know we're going a little over, but I'm going to let Joe kind of close out with a question on that. But anything else you want to add around what I just said?
No, you're absolutely right. Listen, it's true of what you guys need to be doing, loan officers in this particular industry. It's true what we all need to be doing, quite frankly. You've got to give back. And when you give back, you get something in return. And that's just the reality of it. I'll use myself as an example, in all honesty. I spend a lot of time speaking to your industry. I spend a lot of time traveling all over the country at my own cost and my own expense. And I spend a lot of time trying to give back to the industry. Why do I do that? Is it solely out of the goodness of my heart? I mean, I do that because I love the industry. I love you guys that work in the industry. I love the fact that we have this great housing finance system that enables people to pick themselves up, economically. But I also recognize that it's great for my own business as well. And that's just the reality of it. And you should recognize that as well. You get out there, you give back to society, you give back to your community, and it's going to pay off for you. It's absolutely right.
Well, outreach has been part of the theme of this conversation, being so crucial. And I think this message that you shared certainly should motivate folks on the call to reach new markets. But speaking of new markets, there's a population explosion of folks that are reaching the age of 62 and beyond. There is, a whole new attention, both from a regulator's perspective and a lender's perspective, on the HECM solution. And there's record home equity in homes across America. So, what are your thoughts on the new reverse and kind of the HECM market in general, as more and more lenders get asked questions by their prospective borrowers?
So I actually think that the HECM product is a wonderful product. You know, I'm a baby boomer, and I obviously have a lot of friends that are baby boomers as well. I think the HECM market does a fantastic job for seniors in helping them to extend their assets through their retirement. And you know, our lifespans are increasing, which is a very good thing. But for some people, you know, financially, that makes it a little more difficult on them. So, you know, the HECM product, I think it's a fantastic product. I should tell you that, you know, my firm was there from the beginning in the creation of reverse mortgages. We are general counsel to the National Reverse Mortgage Lenders Association. So I am a little biased as it comes to that. And we probably represent every major reverse mortgage lender in this particular industry. And you know, we do that because we believe in this product and we believe that it's a good thing. And it's expanding. I mean, your HECM product is a government product itself. There are at least, I think, 8 different lenders out there today that have proprietary products as well, that I think offer a good alternative. Some of them may even go down to people 55 years and older being able to get that particular reverse mortgage. I think it's great. I think it poses great opportunities for mortgage lenders and for loan officers out there. It's a product that filled a void and is filling a void, and it's growing. It's growing exponentially, and it has a lot more room to grow. I mean, it's an industry and a product that has had growing pains over the years. And, you know, over the years, it had cost the FHA Mutual Mortgage Insurance Fund some money. It lost some money, but not anymore. Not anymore. It's actually making money for the insurance fund as well. And so, yeah, I think it's an important thing to pursue. I love the fact that you guys are getting into that arena as well, because you know, we have an aging population and a great need for that product and products like it.
Well, we spent a lot of time with the lenders that are providing reverse mortgages today, as well as the consumers that were interested. And ultimately, originators that are providing forward mortgages need to get proficient in being able to describe and understand the HECM option. Because if you're not able to understand this option and how people can put this equity to work, you're doing your customer a disservice. Even if you've never done a reverse before, it's important to understand that the option exists and that customers can be served by it. You know, one more question, Mitch, just on data. You know, one of the things is—
Hey, Joe, before we go to data, I want to unpack, and let's close out with the data question, because I want to be respectful of Mitch's time. But Mitch, you know, tell me if you believe what Joe and I both believe. You know, we believe that when it comes to the lack of success, because, you know, let's face it, with the number of HECMs that are out there, and when you look at equity, and you look at the number of families that have HECMs, I don't think it's a success. I think that there's a lot more people that want it than have it. And we believe that it's because it's complex and it's not being explained to them clearly. And we also believe that because while doing a HECM is one thing, being able to have the opening conversation so the family can go forward versus HECM, because not enough loan officers can tell that story,
Right.
And not enough families are understanding that story. That's the biggest reason of the lack of success, which again, we're dedicated to solving by providing a total cost analysis. What are your thoughts on that?
I think you're absolutely right. I think for the most part, it is a misunderstood product, and, you know, and it doesn't help if you as a loan officer don't understand the product and you can't explain it. I think there are a lot of consumers out there that think, wow, reverse mortgage, are they taking my home away from me? What's going on over here? And that's not what a reverse mortgage is. It's further from the truth. I think that, you know, as I said, it's a product that that's needed by a certain segment of our society. And, you know, and for people that don't necessarily need it, it's actually a very helpful, useful financial product as well, that can be used. And yeah, I mean, it's significantly underused because most people don't understand it. And, you know, what I see out there is when they come to an understanding of it, they think, wow, How come I didn't know about this product before? And why is this so good? I think it's absolutely essential. I don't think you can necessarily be a top rate loan officer without an understanding of that particular product. Even if ultimately you're not going to specialize in that product, because most people are not going to specialize in that product, you have to have an understanding of it. And you have to allow your customer to understand the options and alternatives that are available to them.
So guys, now Mitch challenged you guys. You are not a top rate loan officer if you are not able to start that. He's not saying you need to be able to do the loans. You know, there's a specialist in your company. But when you see the release, which is coming soon, that Mortgage Coach has launched a reverse mortgage analysis, you're not playing at the highest level if you're not able to have that introductory conversation and deliver that, you know, forward versus reverse mortgage analysis, and then hand it off to a specialist in your organization. So stay tuned, guys. You know, a month, maybe two, we'll be rolling that out, and hopefully you guys will all tune into it. So Joe, I know you had a last question to wrap this up.
No, thanks, Dave. No, we're just so excited about HECM, and being the first to be able to show a forward and a reverse side by side in this way is going to pave the way for so many of these professionals to have that conversation. And looking forward to a lot of feedback from the folks here on this call. And if you're reverse specialists, feel free to email beta@mortgagecoach.com. Would love to hear your thoughts. And thinking about this outreach, both to reverse folks and folks in markets that are underserved, and just people in general that might be financeable or have record equity that don't even realize how they could put their equity to work for them. Lenders today are aggregating and getting data from a lot of different sources, and more data than ever before is becoming available for purchase, where you can get insights about your past customers or habits or other things that are happening behind the scenes of each transaction and trend. Well, what are your thoughts as lenders have the ability to acquire more data and manage more data? What should they be thinking about, and what new risks are maybe being exposed by what lenders can acquire for themselves?
Well, let me first start off by agreeing with you. The amount of data that's out there today has increased exponentially, and it continues to increase exponentially. And I don't think you can actually be a successful company or have very successful loan originators without the use of data, in all honesty. I think it's essential to this particular business. But it's a tricky area. It's a tricky field. Number one, you need to know what data you need and what data you don't need. You need to know what you're getting. Number two, you need to know and understand who you're getting it from and whether or not they hold that data properly, and what you're going to do with that particular data, because there are privacy issues that are related to all of this. And, lending institutions are financial institutions under Gramm-Leach-Bliley, and there are always privacy concerns, and you have to make sure you live by those privacy concerns. You have to make sure your companies have good, adequate privacy policies that the consumer is aware of. So number one, know where it's coming from and know and understand that, it's proper for the company you're purchasing it from to have that data. Number two, utilize it in that same responsible way as well. Make sure. And number three, one of the most important things and pitfalls about data in today's society, which I'm sure everyone recognizes, is cybersecurity threats to that data. And there are states, almost every state now has either regulatory or statutory, or both statutory and regulatory provisions governing cybersecurity breaches. And you need to understand what that data is, how you can utilize it, and how to protect that data. Absolutely essential. There isn't a week that goes by that you're not reading about some type of a major cybersecurity breach of data itself. So you need to make sure that, in fact, it's safeguarded properly. And I'll tell you, the state regulators that are out there, especially when it comes to the state of California, the state of New York, they're very, very, very tough on lenders that aren't adequately protecting this particular data. So there's a whole slew of issues that stems from that, quite frankly.
So here's what we're going to do, guys. Mitch had told me earlier when we were in Nashville, he would do more calls like this. So I'm going to invite Alex, the CEO of Sales Boomerang, with Joe and I, and we'll schedule something sometime, around Mitch's schedule in his next opening, and we'll keep this conversation going. And if you guys have more questions, if you are a loan officer, if you're a branch manager, you're a regional, you're head of production, there are a lot of CEOs that will watch this call. Put your questions down below. Let us know what questions you want to ask Mitch next time around. We will filter those out. Mitch, you think by next month we could get you back on the Mortgage Coach channel and do another one of these?
Absolutely, man. I'm always happy to share my thoughts with the Mortgage Coach community. It'd be great.
Well, we appreciate you. Any closing thoughts you have before we wrap it up?
I just want to say that, a lot of people are coming into this year with some trepidation, but it looks like it's going to be a really good purchase market, quite frankly. And, listen, I've been doing this for 40 years, and I've been telling lenders for 40 years, you better focus on the purchase part of this particular market. Refinances ebb and flow with the various economic cycles that dictate your interest rates. But your connections, your relationships with referral sources there outside are always absolutely essential. There are more tools than ever available to you to solidify those relationships in a lawful manner. And you gotta study that. You gotta understand what you can do and what you can't do. But I think it's a great industry, and I think that the future is yours. Beautiful.
Joe, any closing thoughts for you?
I'm just so grateful, Mitch, for your willingness to share this insight with our community, and to our community for taking the time to put this education to work and help the families that everyone here serves. So looking forward to more inspiration, Mitch, and thanks for all you do for the industry every day.
All right. Thank you, guys.
So my closing thought, guys, before we wrap it up, here at Mortgage Coach and Sales Boomerang, we are dedicated to clients for life. So Mitch talked about it's a purchase business. Guys, if you're a local referral-based professional, you need to be essential. And that means you need to have data. That means you need to deliver more than a loan manufacturing experience. There are a lot of companies, online companies, automation companies that could close a loan on time, that could deliver a great rate and a great loan manufacturing experience. If you want to be a local professional, depend on referrals, the word is essential. And the other thing I would say is, I love this Sales Boomerang hashtag, no borrower left behind. The way we elevate and the way we make this decade better than the last decade is to make sure that we're doing that with education. We're doing that with data. And we're helping every family understand, what does homeownership mean to them based off of their income, their beliefs on rates, their beliefs on values. Should they move up? Should they go from renting to owning? So guys, be essential. We'll be back next month with Mitch. Mitch Kider, you're the man. We look forward to bringing you back in a little bit.
All right, man. Take care.
Take care, everybody. Give us a like. If you're not subscribing to the channel, hit the subscribe button. Take care, everybody. This is a wrap.
Bye-bye.
Thanks.